Hey everyone, welcome back to Kitco News. I'm Jeremy Szafron. Now, back in early July, we were in Boca Raton, Florida for the Rick Rule Symposium. It's an event that gathered some of the sharpest minds in macro and resource investing. Well, since then, gold has been holding steady again, almost around $3,400, and silver's trading between $37 and $38. And major mining companies have posted some of their strongest earnings in years. Now that the numbers are in and the market's finally reacting, we wanted to bring back Rick Rule to unpack it all, what he took away from the symposium, what companies he's watching now, and how he's positioning in a market that's showing real momentum in hard assets. Rick, welcome back to Kitco. Great to see you as always.
Pleasure, Jeremy, and thank you for your participation in the conference. It was very valuable, and we enjoyed having you down there.
Yeah, thanks for saying that. It was great. And of course, our very own Paul Harris, he was busy. I saw some of those live streams, just some really great insights. And I mean, of course, you had some heavyweight voices on stage this year, those macro thinkers, resource allocators, and real capital in the room. But what hit hardest wasn't just the data. It felt like it was the mood. What was the single biggest thing you walked away from Boca thinking differently about this year?
I would say a couple of things. The first is that attendance was up nicely.
Hmm.
In 2024, about 400 paid live attendees were present. This year, over 600, so 50% growth. In online attendance in 2024, we had 670, if my memory serves me correctly, paid live stream attendance. This year, about 1,450. So the overall attendee growth was, very, very good.
Hmm.
Unlike any other investment conference I know, Jeremy, we offer a full money back guarantee. If you're unhappy with the conference for any reason, we give you a full refund. As far as I know, we've had two refund requests out of over 2,000 people paid,
Wow.
which means that 99.9% of the people who came to the conference and paid for it expressed satisfaction. So I think we did a really good job.
Yeah.
We did a good job for a variety of reasons. Unlike any other conference I know of, every exhibitor at our conference has been vetted. At most conferences, if you pay, you can become an exhibitor. We turn down more exhibitors than we accept. So I would suggest that we had a fairly illustrious group of exhibitors. The second thing is that most of our attendees arrive at the conference already prepared. Most
Hmm.
of them are members of the Rule Classroom, which is a free service that teaches people, among other things, introduction to natural resource investing. So we had a very high quality group of attendees who were given a very high quality program and who expressed very high quality satisfaction. I'm happy in all regards. Next year will be better than this year because every year we poll our attendees. We find that rich people are very generous when we ask them for information about how to service them better.
Yeah.
We expect that this year will be no different.
Yeah, yeah. I mean, I found it fascinating. Obviously, we were talking to a lot of miners, some of those exhibitors, as well as the macro thinkers, and it seemed like everyone said the same thing. Investors are back. We're taking more meetings. Did anything surprise you about how capital allocators are thinking today? Maybe less fear and more urgency, it felt like?
I don't think that's true, but I think more confidence. You'll
Yeah.
remember back in 2023 when Kitco viewers were experiencing frustration, given that the gold price was up, but the gold mining shares weren't up.
Hmm.
That was easy to explain in two fashions. One, the gold price was up because foreign central banks were buying gold and they weren't buying gold shares. So an asset class that had a bid was going up, while one that didn't have a bid was going down. In past bull markets, it has taken a while for the increase in the gold price to follow through to generate increased free cash flow among the gold miners. And that happened in 2024 in spades, and it's happening in 2025 in spades.
Hmm.
What that means is that the prices of the gold miners, as an example, Wheaton Precious Metals, who was an exhibitor, Agnico Eagle, who was an exhibitor, those companies are up in the last 18 months uniformly 100 to 150%.
Hmm.
And it's follow through, I think, gold to the gold shares that attracted our attendees. The thesis is proven. They don't now have to feel like they have to wait for a gold bull market. They understand that they're in a precious metals bull market and that they're in it right now.
Yeah, yeah. And gold's, I mean, still above that 3,300. We saw that little bit of a dip, and of course, everyone bought the dip, and miners finally seem to be waking up. I mean, Newmont, I think you saw, Rick. I mean, beat across the board. You mentioned Agnico's margins; they're remaining strong. Even juniors are starting to get a bid, like Dakota. Are we finally starting to see that disconnect close? I know that you brought it about central banks, but it almost feels like these hard assets are starting to companies are starting to catch the bid.
I think that's true. And you mentioned
Yeah,
the Newmont quarter. I mean, that blew out everybody's
yeah,
earnings estimates, including my own.
yeah,
And frankly, it blew out Newmont's own
yeah.
estimates. What Newmont did, and we talked about this, Jeremy, you and I, a year ago.
Mhm.
Newmont had prior to this quarter 8 bad quarters in terms of sustaining cost performance. What Newmont did is they sold off virtually all of their second tier assets. By the way, raising almost $5 billion in the process.
Mm.
But the other thing they did is free up management time and attention and sustaining capital to focus on their tier one projects. And the operating cost performance was absolutely spectacular. In addition to that, they added almost $5 billion in cash to the balance sheet.
Yeah.
They can deploy some of this for sustaining capital, but they can also give some back to shareholders, which they've elected to do. They've decided that they're going to buy in stock, returning cash to shareholders by reducing the float. Spectacular result,
Yeah.
and that has that's the wealth has been spread around.
Mhm.
With people like Dakota, the market is looking at the Barracks of the world, at the Newmonts of the world, and saying, what are they going to do with all this money? What are they going to do with all this high share price? How are they going to maintain their growth? Maybe they're going to buy something like Dakota.
Yeah. There's been a lot of chatter about M&A, but aside from, those few bolt-ons, the majors haven't acted too aggressively here. I mean, is it the calm before the storm, maybe an inventory supply problem, or is the industry still kind of paralyzed by 2011's PTSD?
I would suspect both of those. That's a great comment. For the viewers who aren't familiar with this statistic, in the period 2000 to 2010, when the gold price went up sevenfold, the free cash flow per share of the gold miners actually declined.
Hmm.
It was a decade of ridiculous malinvestment of capital. The management teams that presided over that dismal performance, pardon me, have been thanked and excused. But the institutional investors and the management teams themselves have kept the mining companies on a very tight leash with regards to capital deployment. My suspicion is that as the metrics around gold companies' valuations increase in a bull market, and as investor concern about companies' ability to maintain or grow their production increases, then you will see increased investment activity, including increased merger and acquisition activity. So I think what you describe as the calm before the storm is
Yeah.
completely accurate,
Okay, let's
Jeremy.
get into what we're buying here. Names. I mean, what specific companies are you kind of accumulating right now? And let's just talk briefly about why before we kind of give more into the macro side.
I've asked most of my attendees to focus on the best names,
Yeah.
the best of the best. The Agnicos of the world, the Francos, the Wheatons, give you surprising performance in a gold bull market with almost no operational risk. For myself, I bought those names 4 years ago and 5 years ago, so I don't have to buy them now. What I'm doing now is coming down the quality trail, looking for big single mine companies that would make attractive bolt-on acquisitions and ones that are cheap. I need to mention too, Jeremy, that I'm much more willing than most to accept political risk.
Yeah.
So names like West African Resources in Africa, Endeavour Mining in Africa are appealing to me because I'm willing to take political risk and because they're extremely cheap by any metric. I personally, too, am going down into the exploration space because I like to be involved in markets where I don't have much company and very much competition. I wouldn't expect the bull market to expand into the exploration space per se for 18 to 24 months, but I like to be in space before the competition is.
Yeah, interesting you say that. I mean, we were talking to Robert Kaplan. I know you know him well, and I was surprised by the interview. He was saying that jurisdictions become one of the top things that he's looking at now. I mean, that is jurisdictional risk kind of priced in, or is it underpriced now in the market?
Tom and I would argue about this.
Yeah, yeah,
I think that let me rephrase it. I don't think there are any good jurisdictions.
right.
The worst experience with political risk I've ever had in my life is the People's Republic of California,
Hmm.
which is regarded as a low risk jurisdiction. The best jurisdictions in my life have been Western Australia and Chile. Chile is getting a little worse as it gets richer. They can afford to be stupid. I think all jurisdictions are lousy. I think the government that's the most dangerous is the government that's closest to you.
Yeah.
But there are certain jurisdictions where companies enjoy a lower cost of capital in accordance with a beauty contest. The Fraser Institute in Vancouver publishes a sentiment list around political risk. They would
Hmm.
describe Saskatchewan, Canada, as the lowest risk jurisdiction on the planet, but they give both Quebec and Ontario fairly high marks. They give certain American jurisdictions, Alaska, Wyoming, Nevada, fairly high regard. They're a little tougher on most other jurisdictions. In my own life, Jeremy, what I've learned is that I try to avoid technical risk. In other words, I try to buy good deposits and I grit my teeth with regards to locations. But I understand that I'm more tolerant of political risk than others.
We haven't talked about silver, but when we were at the show, I mean, obviously gold's been kind of holding strong and the miners are finally getting that bid, but silver's quietly become the best performing commodity on the board. I mean, prices have rallied over 28% year to date. Firms like Sprout are, who you used to be with over there, Rick, are pointing to 7-year structural deficits combined with record demand, as you know. I think the mid-year outlook even raised the possibility of a silver squeeze, not just from industrial users, but from investment flows. Their analyst Maria Shmermova said that silver is undervalued relative to gold and is far more sensitive to incremental buying. Rick, I mean, is silver finally stepping out of gold's shadow, and is it investable on its own merit right now?
Yes and yes.
Yeah.
In my experience, Jeremy, precious metals bull markets are led by gold. They're led by
Mhm.
the fear buyer. They get kicked off because savers and investors are concerned about the deterioration of the purchasing power of domestic currencies, fiat currencies, in regular savings products. Gold moves first. When the move in gold allows producer margins to expand, the senior stocks move next, which is what we've just seen.
Mhm.
At some point in time, the momentum in both gold and gold stocks attracts the generalist investor into the precious metal space. When that happens, perhaps because of its lower unit cost, leadership goes from gold to silver. I've watched this happen 3 times before in my life, and Jeremy,
Mhm.
believe me, you will not need Rick Rule to tell you when it occurs.
Mhm.
Silver is incredibly volatile, both to the upside and the downside. It's the upside that comes next. Uh, as to a squeeze, I think the squeeze comes about, if it comes about, because the trading volume in the futures market is so extraordinary relative to the amount of gold available for good delivery in the physicals market. Many days, single days, the trading market trades 200 times the amount of silver
Mhm.
available for good delivery on the market. The potential for a fairly small number of the futures contracts to hold for delivery and the impact of what that would have on physically available supply could be dramatic.
Yeah. I mean, we've been hearing about that squeeze for a while. It's almost like this little fake out. Everyone goes, when I put a headline, they go, well, you didn't make it. No, we didn't have the
Uh,
squeeze. I wonder if
Jer-
we're getting closer.
well, Jeremy, I think what we need to differentiate between the squeeze that we'll likely see and the squeeze we won't see.
Yeah.
There are some silver bugs who suggest that there will be no silver available, and
Mhm.
as a consequence of that, there will be the mother of all short squeezes on the futures market. That won't happen. Silver futures markets are owned and made by the dealers, by the banks.
Yeah.
What will happen in the event that there is a temporary unavailable of metal is that the markets will suspend the contracts and cash settle. That's what will happen.
Hmm.
This will be extremely pleasant for the people who are long and extremely unpleasant for the people who are short. Who are short. But it won't be the sort of incurable market imbalance that many of the silver bulls dare dream for.
Yeah. I mean, if we're heading to a real silver supply crunch, I mean, who actually positioned to benefit? Is it the producers? Is it royalties? Is it physical holders?
Yes, yes, and yes.
Yeah.
Uh, the physical holder probably in percentage wise benefits
Mhm.
the least. The leveraged futures holder maybe more. The silver producer a lot. But the answer to that is yes, yes, and yes. And of course, the penalty is borne by those who didn't participate or heaven help them,
Yeah.
those who were.
On the minor front, I mean, we talked a little bit about M&A, but it feels like gold, as you mentioned, got a little bit ahead on the M&A side. Silver's catching up. I know there's a lot of people kind of going shopping over at your conference. What companies are best positioned to get in or to be taken out or to go shopping on the other side?
There is a real shortage
Yeah.
of decent quality silver companies, and that's been noted in three prior bull markets. My friend Doug Casey described the circumstance where the generalist investor money comes in the silver equity space as trying to siphon Hoover Dam through a garden hose. There just aren't
Yeah.
enough. Uh, and the big silver names are becoming less silver centric. The go-to name in the last bull market was, of course, Ross Beatty's entry, Silver Standard, where over 50% of revenues are now gold revenues.
Mhm.
There is still a silver constituency. For those people who would like equity vehicles that are very responsive to the silver price, traditionally those include core mining, Hecla, and First Majestic Silver. For people who want really high quality silver names that are maybe less correlated to the silver market, one likely needs to look south of the border. One looks to Fresnillo, uh, one looks to Peñoles,
Mhm.
one looks to Buenaventura. Among the juniors, we had a great list at the conference. We had Aya Gold and Silver, a great small producer. We had Vizsla Silver. We had Abra Silver. Very, very, very small, but list of very high quality discoveries.
Yeah, we also saw when we were in the middle of the conference, I mean, Trump was making more announcements about these strategic minerals, and uranium was very much in the headlines. It's back around 71.50 a pound right now, down from its highs, but still structurally tight. And then with Sprott, SMRs, and national security in play, the long case is still intact. Where are we in the uranium cycle? Is this a pause or kind of a coiled spring?
Yes and yes.
Yeah.
People's time frame with regards to a coiled spring is painfully short for them.
Hmm.
We could easily be in a 12 to 24-month pause. I think people need to understand that there's a lot of nervousness about a recession. And you can have production tightness in electricity if you have demand weakness in electricity without moving the price. And I think we're seeing this. Longer term, I think that uranium is a total coiled spring. What's important about the uranium equities, and we've talked about this on Kitco before,
Hmm.
is increasing prevalence of a term market in uranium rather than a spot market of uranium, so that producers can lock in volume and price for as much as 30 years in the future, which should, over the next 5 years, lower the cost of capital, both debt capital and equity capital. And I don't think one person in 1,000 who is a uranium speculator understands the importance of the term market in uranium. And while we're on the topic of uranium, the quarter that was just released by Cameco rivals the Newmont quarter. It was a
Yeah.
truly spectacular quarter. A quarter that had a lot of things to look at. Great free cash flow, despite the fact that Cameco's average selling price for the quarter was $57 in the spot market where the price exceeded 70.
Hmm.
Well, that means when the short-term contracts roll over in favor of longer-term contracts, there's as much as 20 or $25 in gross selling price. No one knows how much margin. But the second thing it shows is that, at least so far, Cameco has managed the Westinghouse acquisition well, because the contribution of the Westinghouse assets into the Cameco income statement were spectacular. My nervousness about Cameco was always, could they, as miners, manage an engineering, processing, and construction firm? The last three quarters would suggest that the answer to that is a resounding yes.
Cameco, interesting. I mean, you've always kind of said that in the past the great bull markets start when nobody can produce profitability. If that isn't momentum in uranium, then what is?
Well, that's a really good question. I mean, the incredible increase in free cash flow generation at Cameco
Yeah.
tells you probably everything that you need to know about a proxy for the market relative to the price of uranium.
Hmm. We talked a little bit about Trump's tariff policies, fresh at the show because they were coming in and they were coming in hot with copper. I mean, it remained kind of structurally undersupplied. It's hard to permit. But of course, we see Friedland coming out. There's a lot of people that are coming out about copper right now, talking about these deals. Talk to me just briefly about copper's bull case here. Is this the biggest next opportunity? What are your thoughts?
I don't think tariffs are necessarily the opportunity. I think Trump is fairly transactional, and
Yeah.
I think that tariffs are really a bargaining chip for him for political power,
Mhm.
which is not a fundamental around the copper market. The fundamental around the copper market is that we as a society have been underinvesting in copper for 30 years. The exploration work that we need to do to increase production needed to happen in the 1990s, and it didn't. So no matter what we do, we're going to have a structural deficit in supply in copper. At the same time that demand is growing very rapidly. Friedland and others talk about Western demand. They talk about data centers. They talk about electric vehicles. But there's a different side of demand, too, that we
Mhm.
need to talk about. There's a billion people on Earth with no access to primary electricity. We're going to solve that problem over the next 20 or 25 years. It's going to take copper to generate the power they need. It's going to take copper to get the power from where it's generated to where they use it. It's going to take copper in their home and in their vehicles to utilize that power. Demand for electrical power is estimated by the International Energy Agency to double in the period 2025 to 2050, and that takes copper.
Long term case, but I mean, it's there. What names are actually positioned to deliver, copper in this setup without getting blocked politically or financially?
For most investors, they're better off buying beta than buying
Yeah.
alpha, not taking the political risk, but rather buying the best names they can. For
Mhm.
Canadians, that might include Tech Corp. For Americans, that might include Freeport, a great copper producer. Remember that the costs of developing a new copper mine are going up very, very, very rapidly, and that makes existing copper mines much more valuable. One could also look to the senior miners, the BHPs, the Rios, the Glencores, but it's important to note there that while they're important to the copper business, copper is less important to them. They're major multinational mining companies producing a variety of commodities. But as I say, for most investors, they're better off sticking to the best of the best. It's easy in a good market to get a three or fourfold move in a very high quality company without having to take the operational risk that you take when you go into the smaller cap companies on the TSXV.
Yeah, yeah, well said. And let's talk briefly about that capital structure. I know you're a busy man, and it's summer, Rick, but in this environment, I mean, how are you allocating between those royalty plays, producers, high risk speculators? Like, if you had to deploy fresh capital today, first dollar, last dollar, how would you sequence the risk?
What I say is different than what I do
Yeah,
because I allocated to the high quality companies 4 or 5 years ago. I've
yeah.
taken care of the beta part of the transaction. I'm looking lower down the quality trail. I'm looking to valuation discrepancies, smaller companies. I love the royalty business, and royalties and streaming in my portfolio is overweighted relative to the producing companies because although I don't have the same upside with those companies, I have much less downside. The
Mhm.
idea if I manage my risk, the upside takes care of itself in a bull market is something that's been proven to me three prior times in my life. As I said earlier in this interview, I'm going down the quality trail. I'm going to the advanced exploration companies and the prospect generators. While I don't expect them to move for 18 months, I want to be as positioned in the juniors 18 months from now as I am in the seniors today as a consequence of forward thinking, pardon me, speculation. Now, this only works if you are willing to work hard, if you're
Mhm.
patient, if you can accommodate in your psyche the volatility that's inherent in the juniors. But if you're willing to do the work, this is going to be one absolutely epic speculators bull market in the small cap names. I just don't think it can. I don't think it's likely to happen for 12 to 18 months.
Okay, 12 to 18 months. You heard it here. But yeah, I mean, we got Randy Smallwood, the CEO of Wheaton Precious, on the show soon. And it's fascinating to talk to him in terms of the miners. I mean, they got no GA costs. They got no, it's just, they're just printing cash at these levels.
Well, remember too that part of that is Randy himself. He's a truly
True.
superb human being. We've
Yeah.
had him at probably 20 of our conferences. It's Randy is very self-effacing, but he's done a spectacular job growing that company from a 30 million market cap junior to the company it is today.
Yeah, well said. Okay, final topic before we let you go. I mean, we got the tariffs, we got this fiscal recklessness of Fed that's under political pressure, as you know, and then these growing skepticism about every institution, from central banks to credit agencies. I kind of call it the bubble in trust. I mean, there was a lot of people on your stage talking about this. Is the real bubble we're living through not a valuation bubble, but a trust bubble?
I think we had a bubble in trust.
Yeah.
I think the period 1982 to 2022, the most benign economic climate in the history of man,
Mm.
led to too much trust in government, too much trust into big institutions. We're coming to see now with debt and deficits, with exploding bureaucracies, with declining services, the fact that we trusted it too much. Gold does well when people don't trust, when they don't trust the efficacy of investments in fiat currency denominated savings products. What we're seeing now is the erosion of the bubble of trust, the misplaced bubble of trust that we learned to build up in the period 1982 to 2022.
Interesting. Okay. Uh, There's so many follow-ups on that, Rick. I don't even know where to start. But I mean, when confidence in the system breaks faster than expected, what do you think's going to happen here if we're in that bubble?
Well, I think gold is showing you one thing.
Yeah.
When people ask me when gold's going to move, I say, year 2000. It's up
Mhm.
9% compounded for 25 years. It's held its value. The fact that it's held its value relative to Canadian dollar savings products or American dollar savings products is becoming apparent to more people as they trust less. Gold does less well. How we solve society's problems in the United States and Canada, how we come to grips with the fact that our collective expenses are overwhelming our individual ability to create wealth is a very different problem. Perhaps we can deal with that in a subsequent Kitco interview because we can't solve that problem in the time we have left today.
No, we can't, my friend. And of course, you said that similar erosion in institutional trust now that we did heading in the 90s or the 80s, but back then it broke the dollar and it sparked a generational move in gold. I mean, it's similar setup, it feels.
That's a very important note. You missed it by a decade,
Yeah.
but in the period
Yeah.
of the 70s, the
70s.
US dollar lost 75% of its purchasing power,
Yeah.
according to the Office of Management and Budget. I believe, and I said at the conference, that I believe that the US dollar will, in an absolute sense, lose 75% of its purchasing power in the next 10 years, too.
Mhm.
If we look at the decade of the 1970s for guidance, then it's important to note that while the US dollar lost 75% of its purchasing power, gold went up 30-fold. I'm not suggesting that gold's going to go up 30-fold because since 2000, it's already gone up 12-fold. But I would suspect that the gold price gain may very well mirror the decline in the purchasing power of the US dollar.
Hmm.
If the US dollar loses 75% of its purchasing power, one would expect gold to mirror that on the upside.
Yeah, just the start now, $3,400. Crazy how stable it is. All right, Rick Rule, always a pleasure. Thanks for being here today. Have a wonderful summer. And of course, our audience can go and watch the conference over on the website as well. Thanks for this, Rick.
Great. Thank you so
Okay,
much.
appreciate it. All right, everyone, watch what Rick is doing. Watch the cash flow, not the headlines, and ask yourself whether today's valuations reflect today's reality or yesterday's denial. Subscribe right here to Kitco News for more. I'm Jeremy Szafron. We'll see you next time.